So this is the S&P index. It's a monthly chart, so every dot represents an entire month. So it covers a long time period from 1983 up to 2030. I have two moving averages. So the red line is the 200 month moving average, and the brown one is the 50 month. And I have the RSI. Now what I wanted to look at, now if you look at the price action, so this is the chart of the price, we can see, it was going up. This peak is the .com peak. The market crashed. This is the Great Recession, or whatever the name you want to call it, when the lending money to buy houses, even if the person had no money to pay back the loan, that bubble. So that crashed, and this is now. So we are at record levels. What I wanted to look at was the RSI and negative divergence. So in negative divergence, we look at the RSI and see what it is telling us compared to what the price action is telling us. So in negative divergence, you have the RSI peaks well before the price action. So here in the .com bubble, the RSI peaked mid 1997 here, but the prices kept going up and 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 up until mid 2000. So there can be quite a delay. You can see here, this is the peak of the price, and the RSI is far lower. It's only 65 compared to 87, 88. So it was extraordinarily high in 97. Likewise, in this bubble, the peak was in May 2007, but prices peaked November 2007. So not as big a delay as this one, but again, there was a delay. And we would be concerned, that when we see prices going up and up, but that not showing up in the RSI, in the technicals. Now, if you look at our current situation, the prices have been going up, and really not particularly concerned. So the peak of the price is actually today. It's still hitting record highs. But the peak for the RSI was probably here. So that's July 2014. So it's over 2 years ago. So traders, technicians are uncomfortable. When I look at this, I reckon the market should fall. On the plus side, it has at least twice made a reasonable down move. You know, like these were non-trivial corrections. And if there was a bubble to burst, that should have shaken things up. So, you know, if you had a big stress test in a way, when the markets fall like this, if people were over leveraged, then there'd be a cascade. People would have margin calls. They wouldn't be able to pay because they'd bet way more money than they actually had, and this would just collapse. But that didn't happen, which does provide some support. But you know, the RSI has been pretty low. So again, time will tell. And in fact, if you look at the speculative sentiment index, which is something that dailyfx have, the URL for this will be in the description below the video, we can see that the market, speculators, are extremely short. You have a 9-to-1 ratio. So speculators are looking at this and going, I must short. What the speculative sentiment index has found historically is the market goes in the opposite direction to what the traders, the bettors think. So that's why they set this up. They show where, like, what bettors are doing. So this is for euro dollar. In general, people are short euro dollar, like bettors are, the speculators are. So that's a signal that it's going to keep going up. Likewise, the bettors are short the S&P, which they say is a signal that the price is going to keep going up. So that's just something I wanted to mention. It's well worth a look. And it just reminds us that, you know, it's hard work. You can't, it's not, oh, I can work out this calculation and it'll tell me that the actual price is €1.50 while the market price is €1.80, so that's wrong, I'm going to short it. The market can remain mispriced longer than we can remain solvent, as the saying goes. Till next time.